All ends up, it is a positive for the markets. There has been a pause and with a warning that they stand ready to act should the situation warrant. But for the moment, it's a pause. No rate hike, your EMIs are not going up immediately. The second big thing, growth has been actually upped from 6.4 to 6.5% for the current year. Again, that's something the stock market should take very positively. A third, inflation has been brought down for the fourth quarter. My sense is this is a base effect, and we were discussing that just before the governor started speaking. Because the fourth quarter that's just gone by, FY23, you saw the inflation number higher. The base effect brings the next year's fourth quarter down from 5.6 to 5.2, I think is what the governor said. In any case, that seems to be the reason why there is a pause, because that gives a positive real rate already. The other important announcements are, if the credit rating agencies are messing up your life, you can proceed against them. As well, you can get some credit via UPI. That has been eased. I think those would be very important from a corporate and from a consumer standpoint. But the big thing is growth plus inflation down, no rate hike. I mean, all ends up a positive policy. My only point is, how is the Reserve Bank going to explain that if the growth situation is, if anything, better than they thought, 6.5 and not 6.4, then why are you not making a little more effort to come towards your goal of 4% inflation target? You're still far away. Maybe those questions will be asked in the conference of the governor, but at the moment the markets have much to rejoice. And remember, it's not a carte blanche. It's not as if there is no rate hike. There is a possibility at some point in time that hikes may still come. It is still removal of accommodation. So for the moment, it's joy. You can see the 10-year yield has already fallen by about 10 basis points. The 5-year yield has also fallen by about 7-8 basis points. So at the moment, there is joy in the markets. With that, let me go over to our experts. Ritu Singh is also with us, but our experts, Kaushik, Upasna, Ashish of Deutsche Bank, and we also have Rajiv Anand with us. So first to you, Upasna, what have you made? Is it a very pleasant surprise, or do you think a rate hike can still come sometime?
There are two things in this. Obviously, it was a close call. We were calling for a rate hike largely because the previous two readings were above 6%. And we thought probably RBI would not be in a position to really ignore those readings. But having said that, going ahead, they have set the bar quite high for the next rate hike. Obviously, the next few readings are going to be aided by favorable base effect. Alongside, the second half is going to be higher, but we're not looking at readings above 6%. So in the current context, it appears that there will be an extended pause for now. Clearly, the real rates is something which RBI has been emphasizing. The MPC has been emphasizing for a while now. So that also at 130 basis from the new projections that they have provided for. All of that points towards the fact that it will be an extended pause. With obviously data dependency, which clearly RBI has again, the governor has again highlighted.
Okay, so you are not penciling in another hike?
At the moment, I believe that they would want to stay paused. Like I said, the bar has been set high and we're not looking for above 6% readings in the next 2 to 3 quarters.
Okay, well, let me toss the same thing to you, Kaushik. Come as a surprise. We just discussed it before the governor started, that if they bring down the fourth quarter inflation, there can be a very good reason that now the positive real rate is well over 100 basis points, you know, about 120, 130 basis points. So you think that is the reasoning? Your first comments.
Lata, you should get 10 out of 10 for pointing that out, and 5.6 has been brought down to 5.2 in January, March 24. But you never know about these things because, you know, you have El Nino related risk, and you always between September to November, vegetable prices tend to, you know, pick up. So it could very well happen that inflation turns out to be higher than what RBI has projected now. But for the time being, they have used the analogy what you talked about, that if January, March 23 has gone up by 50 basis points, then January, March 24, just the base effect should bring it down. You know, and they have showed 5.2, which brings it to 130 basis points positive real rate, forward looking even with 650, you know, repo rate. What is more surprising is the growth forecast upgrade to 6.5, particularly when RBI is talking about global risk, and the fact that financial conditions have been an important kind of consideration for RBI. I think that is the main reason why RBI is paused at this point of time. RBI is trying hard to kind of tell the market that, this is just a temporary one. If required, we'll go and hike more. But as Upasana said, like, if you think about it, if they have not hiked it at 6.4, 6.5 inflation, and the next inflation print that they're showing 5.1 for April, June, and 5.4 for July to December, I don't think RBI will hike anymore if they have not hiked now. But remember that liquidity will be tightening quite a lot from April, and that itself could put MIBOR and the short-term rates above the 650 policy rate. At times you'll see at 675. So without even hiking the policy rate, RBI can achieve higher than 650 short-term rates if they want to. So I think the rate hike cycle is almost done.
Yeah. That's very well pointed out, that liquidity itself can push up yields. And yeah, the important point, I think the question, we will be all pouncing on the governor. The RBI is getting outlierer and outlierer in its growth forecast. No one has 6.5 out there. The World Bank has brought it down from 6.6 to 6.3. I think among the economists, if I'm not mistaken, Shaktikanta is the only one with 6.2. A lot of people are below 6%. The people who were calling for a pause, like Sonal Verma of Nomura, have a 5.5% GDP growth. So that is the only inexplicable part. Why are you so positive when the world is closing in on you with a possible slowdown? Now, Ashish, I want to know what will be your, range for the 10-year. Now it's come down to below 7.2. But more importantly, what do you make of these NDF liberalizations? You can offer derivative products. Is that a big deal?
Yeah, Lata. I think my sense on the 10-year is that it will remain in the region of about 715 to 725. I think today is a reaction to clearly that there is no rate hike. But going ahead, the supply fears will sort of catch up. So that's something which one has to look forward for. But it's also going to be dependent upon the overall global rate trajectory, and which seems to be on the softer side. So like Kaushik pointed out, I think broadly we are at the cusp of the entire rate cycle. Obviously, it's a wait and watch from here because the governor is not very comfortable about the inflation trajectory going ahead. So that's a sort of a wait and watch. On your question regarding the NDF, I think clearly the RBI has stepped up on bringing in more liquidity and more transparency in the pricing of the entire NDF curve. And in fact, there is a opening up even in the basically the interest rate market and the FX market. So that trajectory continues. I think broadly what we are trying to do as a country is trying to bring the entire risk management onshore, in the sense the entire risk management has to be driven out of the India piece. And it's not about only the foreigners expressing their view from the outside. So I think that's clearly a direction, and I think and it's a very positive move which the RBI has done in terms of offering CCS and NDS to the onshore. I think that's a very positive move.
Yeah, and I think this confidence may be stemming from the fact that our current account is not such a big deficit. Attack on the rupee and the general feeling that the dollar is also going to weaken, all this is making them perhaps bolder to open the FX market. I think this will attract a lot of attention, the opening up in the FX markets as well. But what does all this do to the banks? Remember, the banks were enjoying higher margins because most of their loans are tied to the repo rate. Now they can't raise their lending rate because it is tied to the repo rate, and the repo rate has not gone up. So Rajiv Anand, is this going to be a period where you will not celebrate the pause because your NIMs could be under pressure?
I think, Lata, there are multiple levers for NIMs. One is obviously the book that is linked to external benchmarks now will no longer go up, at least in the short to medium term. However, I think the pressure that we are seeing on the deposit side could ease just a little bit as well. And so to that extent, there is repricing that needs to happen on the deposit side. There's repricing that needs to happen on the asset side as well. So I think the environment that the governor has painted is actually quite positive for banks. And I think the most important is the point that you highlighted as well, that growth for 23-24 has been increased, which means that for us to support credit demand, to support 6.5% growth, we will see fairly robust credit demand as well. So in an environment, 23-24 looks like an environment where NIMs will remain more or less stable. However, we should see fairly robust growth of the book, which I think, you put it all together, is quite positive for banks.
All right, positive for banks and robust growth ahead as far as lending is concerned. Upasana, let me come back to you. And it's very interesting that this time around, the decision on the rate pausing at least is quite unanimous, something that we haven't seen in the many past MPC meets. Now we have a unanimous decision on pausing the repo rate. But at the same time, Upasana, how do you read through the comments of the governor when he's saying, very specifically reiterating that this pause is only for this policy? Are we done with the rate hikes yet? Or is this a signal that we're still watching out for how inflation plays, even though by RBI's own forecast is expected to come within, the target 2 to 6% as early as next quarter?
I think you're absolutely right. There are two things here again. One is RBI has been mentioning for quite some time that they are going to be re-evaluating the impact of the previous rate hikes on how the overall economy is going to pan out going ahead. And I think that is something which they have, that may be the reason why all the other, non-descending members earlier, the 4 members who were earlier not in favor of a pause, have also agreed to evaluate. And that is where there is a possibility, not ruling out another rate hike in future, but if in the event of the previous two inflation readings, which were higher than 6%, like I said before, we haven't seen a potential rate hike here. I think the chances are low, but they will continue to re-emphasize their focus on inflation. This is an environment which is full of uncertainty. We're talking about monsoon risks. We're talking about crude oil related upside pressures, which could come about because of OPEC going ahead if China revives faster than what we are anticipating. So there are a whole lot of uncertainties going ahead, and RBI will have to evaluate the data as things happen. Again, even on the growth front, they are very optimistic at the moment. So they will have to weigh the growth versus inflation trade-off over a period of time and keep taking a stand. So I think that sword of a possibility of a rate hike will be there for some more time before we can really say that we are done and dusted with. But nonetheless, I think my view is that we will probably be in for an extended pause.
But Upasana, do you think we could see an out-of-cycle rate hike as well, given the statements that the governor has made?
No, I would rule that out, really. I think out-of-cycle rate hike would not be done with. But our projections on inflation are slightly higher for Q2 and Q3 compared to what RBI has just released. But even then, we are not really going higher than 6%. So overall, our average for the full year is 5.5% inflation, which is 30 basis higher than what RBI is saying. Despite that, I don't see readings above 6%. So out-of-cycle rate hike seems to be ruled out.
Well, Kaushik, I just wanted to ask you, how is the RBI going to justify the 6.5? Do you know anyone else who has such a robust growth forecast for next year in what looks like a gloomy global environment? And would that make you revise up your growth forecast?
So, Lata, we have our growth forecast for a long time at 6%, and we had 7% for FY23 when people brought it down to 6.8. So now it looks like it will be 7% for FY23. So we don't change our growth forecast too easily. We'll stick to 6% because there are a lot of downside risks, particularly what has happened in the US and, the spillover impact of tighter credit conditions from global financial markets, which can spill over into the whole world with a lag. So all those risks are there. So therefore, 6% we are comfortable at this stage. Probably one reason why RBI has increased is because of the revision that have happened to FY23 quarterly numbers. So probably for that reason, they could justify a little bit of, upside. But still 6.4, 6.5 looks like on the higher side compared to the consensus that we have at this stage. Particularly even April, June, we understand there's a positive base effect, and but the number that they have given is quite high, and particularly the second half of the financial year of FY24. If you assume that the US is going to go into a recession by third quarter or second half of 2023, India will also, not be immune to those kind of slowdown risks. So to that extent, the second half forecast that has been given by RBI, and partly it has been revised up, that could also be facing some downside risk. So I think if India does 6% on the back of a 7% growth in FY23, that itself is quite commendable. We have 6.5% growth, but for FY25, after the elections are behind us, we would expect more focus on the macro from FY25. And normally we have seen in our studies that after the election year, growth tends to pick up. So if you think that RBI has hiked enough, 300 basis points, that has to have some impact on private consumption, which itself is 60% of GDP. And you've seen in October, December, there's been a slowdown in private consumption. Then probably 6% looks more likely than the 6.5% range that RBI has shown at this stage.
Okay. Yeah, I know. We will perhaps hear from the governor what is their justification for actually increasing an already high growth estimate compared to what other agencies and banks have at the moment. Rajiv Arad, I wanted to know from you, why do you think margins may not be crunched? There is a liquidity deficit in the interbank market. Right now, the government has spent in early April, and therefore there is a bit of a surplus, and the VRR will absorb that money. But otherwise, it looks like there is going to be intermittent deficit in the market. So deposit rates will have to be hiked, no? And you can't hike your lending rate. So, I mean, the period of rising NIMs is over. In fact, a little bit of sacrifice is in order.
I think the words that I used is more or less stable. There could be some element of downside to this. I think the way to think about this, Lata, is that we've seen, pre 31st March, we've seen a significant repricing both on non-retail deposits as well as significant component of the retail deposit book as well. Remember that for most of the large banks, 45-46% is in CASA, which doesn't reprice, and so therefore it's really the retail and non-retail term deposits which will reprice, and much of that repricing has already played out. I don't anticipate. I mean, if, today, for example, in most banks you can get a 8% rate for 1 year, and I think in an environment where the policy rate is at 6.5%. A rate of between 7.5% to 8% for a 1 year fixed deposit is quite attractive. So I don't see those rates, going up. However, on the other side, as we begin to see more robust, credit demand, remember that there has been policy changes on the mutual fund side, and that certainly should have implications on the bond markets, at least in terms of demand for corporate bonds. Similarly, there is refinancing of a fairly large amount of ECBs that needs to play out in an environment where global liquidity is tight. We will see more and more of this stuff coming on to bank loans, and that should give us an opportunity to increase spreads as well. Remember that if you look at it pre-COVID to today, most rates are back to pre-COVID levels except corporate levels, which if you look at spreads for AAAs used to be, let's say, about 100-120 basis points pre-COVID. Today, we are at about 50 to 60 basis points. I do anticipate that corporate credit spreads will go up in the medium term.
All right, Mr. Anand, do stay on. We'll come back to you on some of the non-policy measures as well. But let me quickly introduce Lakshmi Iyer, who's back with us now. Lakshmi, bond markets are happy. I mean, growth rates forecast revised up, inflation revised down, and a pause in the policy.
Absolutely. So, I did mention before the policy that, the head obviously is rooting for a rate hike and the heart could mean a pause. And I think in true sense, I think that's what the bond markets are reflecting. If you look at the bond markets, the easing in yields have been about 6 to 7 basis points. From 7.28, we went to about 7.15. We are back to about 7.21. But the bigger action is actually in the swap market, where you have seen almost 15 to 17 basis points of downward movement. And I think that market, as we, of course, today is a day of adjustments, as you see, and then, you saw some of the traders or the bond market participants sitting on lighter positions. So some bit of that covering, etc. Once the market stabilizes, I think looks like we are going to trade in a tight groove. We must not forget that there is going to be week-on-week supply. And I do agree with Rajiv that the corporate bond markets, for now, the mutual funds actually will be the deployment stage, given the kind of flows that they got in the last 5 days of the financial year, the previous financial year. Adjusting for all of that, as yields normalize, I think it's going to be back to the global market sentiments, and of course what the central bankers globally decide the next month.
All right, that is an important cue to watch out for. But Mr. Anand, let me come back to you now on the non-policy measure, and that is RBI proposing to expand the scope of UPI yet again, and now saying that pre-sanctioned credit lines by banks can be sanctioned, can be routed through the UPI. If you could explain to our viewers what is the significance of this move and how this would work.
Look at UPI from the perspective of merchants. I mean, today you can go to literally millions of merchants who accept UPI payments, right? Both online as well as offline. And there are multiple ways that you can make these transactions, either a debit to your bank account. Now the new policy is debit to your credit card, a RuPay credit card. And what is now being also permitted is to create a loan account for payment of UPI. So therefore, for customers, for example, who don't have a credit card now, can actually get a short-term loan, a personal loan, and with that account use the capabilities and the power of UPI to make small, large payments, as the case may be. So it just expands the banking side of UPI. Merchant, we already know about the fact that there are now millions and millions of customers, millions and millions of merchants who accept UPI. Now there are multiple options for customers to use UPI through the bank account, debit to the money that you already have through a credit card structure, or now a loan structure. I think it's quite quite profound.
Okay, but Rajiv, what happens? Let me suppose I have to pay my child's fees in June and I don't have that much money. So the borrower has to approach the bank and say, sanction me so much, and then that UPI account will be able to be used to pay those fees, even if it is not there, even if that money is not there in the account. There has to be a approach of the borrower to you, right? Okay,
that's correct.
Okay.
That's
fine.
correct.
Maybe we should spread the word far and wide. Okay, got that.
Today you can only hook it to your bank account. Now you can go to the bank, get a loan account, and hook the loan account to UPI as well.
To the... Oh, right, got that. Okay, now I wanted to ask Ashish. Ashish, how will the rupee react? At the moment, I think it's still high, 81.94, so stronger than we closed yesterday. But will not an exporter say, I'm getting only 6.5 or whatever, even less if it is overnight for my money if I convert it into rupees. But if I keep it in dollars, I'm still getting a decent, 3.5%, 4%. So will there be some hesitation on the part of the exporter to bring in money? Do you see any dissonance and depreciation of the rupee because of today's policy announcement?
So Lata, thanks. I think this is a very good question. So let me give you a little bit of a different perspective. I think in the last 30, 40 years, obviously the US dollar has been the reserve currency. So basically, every monetary policy in the system becomes a subset of the US what US is doing. Now, what's really happened in the last, in fact, if you notice, every risk-off event, you have seen the US dollar really appreciate. Interestingly, this time in the SVB event, the US dollar did not appreciate. So this is something which is pointing towards a situation where there are blocks of power which are trying to move away from US dollar as a reserve currency. And that's where, to my mind, even the comfort of the RBI comes in, that there is a possibility of bilateral trades happening across for trade. And there is not so much of need for creating large US dollar reserves. So I think it has to be looked in that context. And my sense is that this time the RBI did not go ahead with the hike because broadly on the macro stack, I think the dollar strength is getting a little bit weaker despite noises in the system. So that's one thing. Then clearly, that drives home the point that eventually, at least my sense is that the dollar rupee pair actually starts looking fairly attractive. And overall, looking at interest rate differentials and inflation differentials, I would not be surprised to see US dollar INR pair actually trading much lower in times to come.
All right. Let me quickly get some comments from Kaushik as well. We're going to hear from the governor very soon on the surprise action and, the rationale for revising the growth forecast up and the inflation down. But Kaushik, are there any clarifications that you would want to hear from the governor? And in terms of next policy action, what are you expecting through the course of this calendar year?
So, Ritu, I think more or less the rate hike cycle is done, as I mentioned before the policy as well. Whether it's 650 or 675, it's a very subjective call. As I said, you can keep 650 policy rate and still achieve 675 if the liquidity continues to remain tight. RBI has complete control over liquidity. So that's not a big issue. I think the cycle at 650 is at the peak. From here on, I don't expect RBI to hike because inflation would come down. And, the next question for markets would be how soon RBI starts cutting rates, which may not come very soon, but at least that will be the focus of the market and the discussion will, move in that direction. And that will also depend on when the Fed starts cutting their own rates. As you know, that market is pricing in rate cuts from the US Federal Reserve in 2023 itself. If that were to happen, then whether RBI joins the Fed in cutting rates in 2023, or can they, wait till early 2024 to cut rates? Our own forecast is that after this policy, the next move probably would be in April of next year when RBI starts cutting rates, and they probably would be cutting by 100 basis points to bring the policy rate from 6.5 to 5.5. Think of it in this way, that post-COVID, inflation would average around 5 to 5.5%. So if you keep policy rate at 6.5, when inflation is supposed to be around 5.2 to 5.5, your real rates are positive by 100 basis points. That's good enough. After a couple of years, inflation should be in the 4.5-5% range as supply issues come under control, and RBI's rate hike starts impacting the real economy. So I think 5.5 policy rate in 2024 is something which you can expect. But at this point of time, I think the rate hike cycle is done. One thing which I would like to say, RBI kept on saying that they would remain nimble, they would remain calibrated and measured in their approach as far as rate hikes are concerned. Given the financial stability concerns globally that we have seen, I think this is a very good step that the RBI has taken of not rocking the boat at this point of time. If anything requires to be done later, they can do it. But at this point of time, 650 is good enough. Remember that they have hiked around 300 basis points of short-term rates in a very, very small period of time. So that itself will have its own impact on the real economy with a lag. So I think RBI has done its job, and from here on, it will be an autopilot mode. Inflation would be coming off. Growth probably could be slightly lower than what RBI has predicted. And then the next focus of discussion would be when would RBI start cutting rates.
Okay. All right. People talking about rate cuts rather freely. Thank you very much. Kaushik, Upasna, Lakshmi, Rajiv Anand, Ashish Vaidya. Sorry if I apologize if I have missed out anyone, but thank you very much for enriching our understanding of the policy. The key takeaway from the policy, it is a bit of a pleasant surprise. The Reserve Bank has not hiked rates and has indicated it will stay nimble, but the understanding of the market is that rates have peaked at 6.5%. The second big takeaway is that the growth forecast has been upped, and what surprises me is that I don't see so much jubilation in the stock market from a hike in the Reserve Bank's expectation of GDP growth for the current year. So clearly there are enough skeptics over there, or perhaps other reasons. The bank Nifty has not moved much. One would have expected that bank investors are a bit worried that the expected rise in NIMs is probably stalling for now. So maybe that's explaining why the markets are not at the moment very, very jubilant. Let's wait and see how they react. But there will be many questions for the Reserve Bank. Has 4% been forgotten? People are talking about rate cuts rather freely. When is the target of 4% coming at all for the Reserve Bank? What is their enthusiasm, or what are they seeing which the economists are not, to take the growth forecast to 6.5%? And of course, what are their views on liquidity? Many questions are yet to be answered by the Reserve Bank. So it's going to be a very, very important press conference that will start at 12 noon. For the moment, there is jubilation in the bond markets. The expected rate hike has not come. With that, from me and Ritu Singh, thank you very much for watching this special edition on the Reserve Bank monetary policy. We will connect again from Mint Street at 12 noon. Until then, it is back to trading hour and to the stock market.